Have you noticed how quickly sentiment in the precious metal markets changed? Just weeks ago, many investors were asking whether gold and silver could continue climbing. Now, after one of the most challenging quarters for gold in more than a decade, major financial institutions are revising their outlooks, volatility has increased, and many investors are questioning what comes next. In today's update, we're taking a closer look at the latest developments, the recent adjustments from several global banks, and what these changes could mean for anyone following the gold and silver markets. The precious metals market has recently experienced one of its weakest quarterly performances since 2013, creating uncertainty across the investment community. Alongside the decline, silver has faced additional pressure from margin calls, while major financial institutions have updated or lowered portions of their near-term forecasts. These developments have naturally led many investors to ask whether the recent highs marked a temporary peak or simply another stage within a much larger market cycle. Rather than reacting to short-term price swings, it is important to examine the broader picture. Large financial institutions regularly reassess their projections as new economic data becomes available. Forecast revisions are a normal part of the investment process and often reflect changing expectations for interest rates, inflation, central bank policy, currency movements, and global economic conditions. In this update, we're going to examine several of the latest outlook changes issued by major banks and discuss the factors that may be influencing their decisions. Understanding why these revisions are happening can provide valuable context instead of focusing only on the headlines. It's also worth remembering that many long-term forecasts remain separate from short-term market volatility. While recent price action has attracted significant attention, some longer-term projections have not been revised and continue to reflect expectations extending well into next year. Market participants frequently distinguish between near-term fluctuations and longer investment horizons, especially in asset classes that have historically experienced periods of elevated volatility. As of the latest market data, spot gold and spot silver continue to trade well below some of the more optimistic long-term projections discussed by various analysts. That gap highlights an important reality. Forecasts are estimates based on current information rather than guarantees of future performance. As economic conditions evolve, expectations can change accordingly. Another indicator attracting attention is the recent movement in market pressure measures, which suggests that underlying conditions have shifted noticeably over the past several weeks. While these indicators do not predict future prices with certainty, they can provide additional insight into changes in market momentum and investor positioning. The key takeaway is that significant developments are occurring beneath the surface of the precious metals market. Price movements alone rarely tell the complete story. Institutional positioning, central bank expectations, macroeconomic trends, and investor sentiment all contribute to the direction of gold and silver over time. Let's now turn our attention to the latest updates from major financial institutions. Several banks have recently adjusted portions of their outlooks, and each revision reflects a different interpretation of current market conditions. Looking at these changes collectively offers a more balanced understanding of where professional analysts believe the market may be heading and which economic factors they consider most important in the months ahead. One of the most important ways to understand what may influence gold and silver over the coming months is to watch the same economic indicators that professional analysts, economists, and institutional investors follow every week. These indicators do not provide certainty about where prices will go next, but they help build a clearer picture of the broader economic environment. Precious metals rarely move because of a single headline. Instead, they often respond to a combination of inflation expectations, interest rate policy, currency movements, labor market conditions, manufacturing activity, and shifts in investor confidence. Looking at these factors together can provide much more context than reacting to daily price swings alone. A good place to begin is inflation data. Reports that measure changes in consumer and producer prices often receive significant attention, because inflation has historically been one of the key factors influencing precious metals. When inflation remains elevated for an extended period, investors frequently reassess the purchasing power of paper currencies. Gold in particular has long been viewed by many market participants as one of several assets that may help preserve value over long periods, although its performance varies across different economic cycles. Silver shares some of these characteristics while also being influenced by industrial demand, giving it a somewhat different profile. Rather than focusing on a single monthly inflation report, analysts often look for broader trends that develop over several months to understand whether price pressures are accelerating, stabilizing, or gradually easing. Closely connected to inflation are central bank interest rate decisions. Monetary policy influences borrowing costs throughout the economy and can affect everything from consumer spending to business investment. When policymakers adjust benchmark interest rates, investors often reconsider how different asset classes compare in terms of potential returns and risk. Expectations surrounding future policy decisions can sometimes move markets even before any official announcement is made. This is why speeches from central bank officials, meeting minutes, and updated economic projections are monitored carefully. Markets are often responding not only to what policymakers decide today, but also to what they communicate about the months ahead. Government bond yields are another important piece of the puzzle. Yields reflect the return investors receive from holding government debt and are closely watched because they influence financing costs across the economy. Changes in yields can alter the relative appeal of different investments, including precious metals. Analysts often pay attention to both nominal yields and inflation-adjusted, or real yields, as these measures provide additional insight into financial conditions, rather than examining a single day's movement. Professionals typically evaluate longer-term trends and consider them alongside inflation expectations and central bank policy, the strength of the U.S. Dollar also remains a significant variable because gold and silver are commonly priced in dollars on international markets. Currency movements can influence purchasing power for buyers around the world and may affect demand in different regions. A stronger dollar can coincide with different market dynamics than a weaker dollar, but the relationship is not always straightforward. There are periods when precious metals and the dollar have moved in similar directions due to broader economic uncertainty. For this reason, experienced analysts usually avoid relying on one indicator in isolation and instead consider how several variables are interacting at the same time. Employment data is another indicator that attracts substantial attention. Reports on job creation, unemployment rates, wage growth, and labor force participation provide insight into the health of the broader economy. A resilient labor market may suggest continued economic expansion, while signs of weakening employment can influence expectations about future monetary policy and overall economic growth. Because employment statistics often shape expectations for interest rates, they can indirectly affect market sentiment toward a wide range of financial assets, including precious metals. Economic growth indicators such as gross domestic product also contribute to the overall picture. GDP measures the value of goods and services produced within an economy and is commonly used as one gauge of economic activity. Investors often compare GDP figures with business investment, consumer spending, and manufacturing output to assess whether economic momentum is strengthening or slowing. These trends do not automatically determine the direction of gold or silver prices, but they can influence expectations about future policy decisions and financial conditions. Manufacturing surveys deserve attention as well, particularly because silver has substantial industrial applications. Purchasing managers' indexes, factory production reports, and industrial output data offer insight into business activity across multiple sectors. Since silver is used in electronics, renewable energy technologies, medical equipment, and other manufacturing processes, changes in industrial demand can become one of several factors affecting market sentiment. Analysts frequently examine whether manufacturing activity is expanding or contracting and how those trends compare across major economies. Consumer confidence and business confidence surveys provide another layer of information. These reports attempt to measure how households and businesses feel about current economic conditions and future prospects. Although confidence surveys represent sentiment rather than hard economic output, they can influence spending decisions, hiring plans, and investment activity. Because financial markets often react to expectations before changes appear in official economic statistics. Confidence indicators sometimes receive close attention from market participants seeking early signals of shifting economic conditions. Retail sales reports also help investors understand consumer behavior. Consumer spending represents a substantial portion of economic activity in many countries, making retail sales an important measure of demand. Strong consumer activity may indicate resilience within the economy, while weaker spending can encourage closer examination of broader economic trends. Like most indicators, retail sales are generally interpreted alongside employment, inflation, and income data rather than viewed independently. Housing market statistics offer additional clues about economic momentum. Reports covering home sales, housing starts, building permits, and mortgage activity can provide insight into consumer confidence and broader financial conditions. Housing often responds to changes in interest rates, making it another sector closely connected to monetary policy. Analysts may use these reports to assess whether tighter or more accommodative financial conditions are influencing economic activity. Global trade data should not be overlooked either. International trade flows reveal changes in demand across major economies and can highlight shifts in manufacturing activity, commodity consumption, and supply chain conditions. Since precious metals trade within a global marketplace, developments in one region can influence sentiment elsewhere. Economic reports from North America, Europe, and Asia frequently receive attention because of their combined influence on worldwide financial markets. Another area that professionals monitor carefully is central bank activity involving gold reserves. While these purchases or sales do not necessarily determine short-term price movements, they contribute to broader assessments of long-term demand. Publicly available reserve data can provide insight into how different countries are managing portions of their official assets. Analysts generally view these developments as one element within a much larger framework that includes inflation, monetary policy, currency movements, and global economic conditions. Exchange-traded fund flows are also widely followed because they can offer a window into investor sentiment. Changes in holdings may reflect shifts in demand among institutional and retail investors. However, these flows can fluctuate significantly over short periods, so they are typically evaluated alongside other market data rather than treated as standalone signals. Market volatility itself is another indicator worth observing. Measures of volatility can reveal changing expectations about uncertainty across financial markets. During periods of heightened uncertainty, investors often pay closer attention to traditional defensive assets, although historical performance has varied across different market environments. Understanding changes in volatility can help explain why asset prices sometimes move sharply even when economic fundamentals appear relatively stable. Finally, it is important to remember that no single economic report determines the future direction of gold or silver. Markets continuously absorb new information, reassess expectations, and adjust prices based on an evolving combination of economic data, policy developments, corporate activity, and global events. Professional analysts rarely rely on one statistic in isolation. Instead, they evaluate how multiple indicators align over time, looking for consistent patterns rather than reacting to every individual headline. This broader perspective can help explain why markets sometimes respond differently to similar economic reports depending on the wider economic backdrop and prevailing investor expectations.